Give a look at a stock and wonder, is this a good buy or not? What I'm going to do in this video is show you how to calculate the stock price of the company, and then we could compare it to the actual stock price to see if it's a buy or a sell. That's what we call the intrinsic value. And we're going to estimate the future free cash flows of the company, and I'm going to show you how to enter the financial information into the model and how to calculate the weighted average cost of capital. You're going to learn a lot, and when you hear this sound, there's going to be more information on the screen about the company and about reading financials. This is what equity analysts on Wall Street do to value a company, and I'm going to show you how to do it in this video. The company we're going to look at today is Tyson Foods, and this is the second largest processor of chicken, beef, and pork in the world. There's only one other company, JBS, that's a Brazilian company that's bigger. And if you ever seen Jimmy Dean, Hillshire Farm, Ballpark, these are all Tyson Foods products. They're the 80th largest U.S. company in terms of revenue. And Tyson Foods has been in a lot of hot water lately because 25 of its workers died of COVID-19 because they didn't protect their workspace. Now let's go into the model. So their market cap is $22.6 billion and their stock price is $62.20. So that's what they're trading at. We're going to calculate the intrinsic stock price of Tyson Foods and figure out if the company's worth a buy or not. And let's get into the model. First, we need the free cash flows, and let's go to the financial section in Yahoo. And we're going to take 4 years of free cash flow. That's the cash that's left over after operating the business. And we also need net income. That's a profit and loss on the income statement. And it's important the numbers are fairly consistent and positive, because if they're not, then it makes it really hard to identify the intrinsic value. So DCF models generally work best for companies that are stable and mature. It doesn't really work too well for startups that are investing money into their business that have a lot of losses. We're looking at the capital structure now to see what their weighted average cost of capital is going to be. And the cost of their debt is $462 million. That's how much interest they paid last year. And let's see how much debt they have. We'll go to the balance sheet for that. $2.1 billion of current debt. And then long-term debt is $9.8 billion. So the difference is current debt is due within 12 months. Long-term debt is due after 12 months. So they pay 3.9% interest on their debt. But interest is tax deductible. So let's get their effective tax rate. So the income before tax is $2.4 billion. And the income tax is $400 million. So the effective tax rate is 16.3%. So the cost of debt is 3.25%. And they have a 35% debt in their capital structure. That's not too bad. As long as it's under 50%, it's manageable. Let's get their beta. This is the volatility of the stock. And they have a really low beta, 0.65. That means if the market goes up 1%, this stock would go up 0.65%. So low volatility is good. And to figure out their WACC, their weighted average cost of capital, we're going to combine the cost of equity, which is 7.3%, cost of debt, which is 3.2%, and we get a WACC of 5.9%. And that's what we're going to use to discount the future cash flows by. And now that we have the estimated future free cash flows for 4 years, plus we got the terminal value, which is all years past year 4, we discounted those values back to today's dollars using the weighted average cost of capital that we just calculated. We get a value for the company of $25 billion. And we divide that by 363 million shares, we get an intrinsic stock price, $69. The stock is trading really close to intrinsic value. The stock is trading at $62.20, and its intrinsic value is $69. So it's trading at a 10% discount. So it is a buy according to the model, but that's really close. So usually you want more of a spread. If it was calculated at $75, $80, I would definitely jump in on this. But it's a little too close, so that's kind of a game time decision. And the stock price could always trade higher or lower than intrinsic value, because the stock price is predicated on what people feel about the future of a company. If they feel this company is going to be struggling in the future, the sales are going to be weak, they probably wouldn't buy the stock. If people feel the company's going to do really well and it's going to have really strong positive free cash flow and net income. The more people that want to buy the stock, the higher the price of the stock goes. It keeps pushing it higher and higher. And when people don't want to buy the stock, they tend to sell their own stock, and then that pushes the price lower and lower. So stock price is really based on supply and demand in the market. And the way people identify a stock price, whether it's good or bad, they look at the financials, which is what we just did. There's also technical factors like competition of other companies, and then there's just market sentiment of how people feel about the company. Let's look at their financial ratios. So first we need to go back to the balance sheet, and we'll look at their current assets. So that's just assets that can be easily liquidated into cash. So that's 7.2 billion. And let's get their current liabilities. Next, we need the equity. That's the value of the company. That's total assets minus total liabilities. And their earnings before interest and taxes, which is the same as operating income. That's 2.8 billion. So now that we have their ratios, let's see how they look. Great PE, 11.2. I like to see under 15, but make sure when you look at the PE, it's not manipulated by stock buybacks or the way they depreciate their assets. Really great price to sales ratio. I like to see under 2.2. They have 0.5. This is how much investors are willing to pay per dollar of sales. So they're doing a really good job generating sales. Price to book, I like to see under 3.3. This is 1.6. This is the price of the stock over the book value per share. And the book value is the same as equity. And next is current ratio. Really good current ratio, 1.3. I like to see between 1.2 and 2. This implies that they have enough current assets to fund their current liabilities. So the ROE is a little lower than what I prefer. 14% ROE. I like to see 20% or higher. So let's look at their interest coverage ratio. That's a pretty good number. That means they could cover the interest on their debt payments, that $462 million. They cover it at least 6 times. So that gives me comfort that they're probably not going to default anytime soon. And let's look at their default risk, 0%. So it looks like a pretty healthy company. Let me know what you think in the comments. Thanks for watching the video.